Had producer inflation numbers out yesterday, and this is following on from consumer inflation numbers on Wednesday. PPI higher than expected at 7.8%, and yet we had the CPI a little bit lower than expected at 3.5% the day before. Is this something we should be concerned about?
Good morning, Stephen. I don't think we should be overly concerned about yesterday's print. It was more or less in line with expectations, as you say, slightly higher, but no reason to be overly concerned. And I think also the important thing to mention, something that we've stated a number of times on the show, is that the feed-through effect from producer inflation onto consumer inflation is not as strong as it used to be. So even though inflation at the producer level is printing around 7, almost 8%, I think consumer inflation remains well contained, and it's indicative of an environment where producers are loath and very scared to pass on high prices to the consumer, because he knows that consumer demand remains fairly fragile. So at this stage of the game, I think at least inflation at the consumer level remains the key thing to watch, and in that regard, inflation looks pretty benign.
So yesterday's reading then doesn't change interest rate expectations at this stage?
At the moment, no. The market is still pricing around a 30% probability of an interest rate cut at the November meeting. We, Standard Bank, don't expect another interest rate cut, but we are aware of the risks, and the risks are to the downside that they do in fact cut, and that's obviously as a result of a strong rand environment and the fact that CPI prints continue to surprise to the downside. So we're going to be watching the data in the coming months, and of course what happens to the currency.
Well, perhaps what might have been more concerning yesterday was the 4.7 billion rand trade deficit we recorded for August, and that followed a 2 billion rand surplus back in July. Exports falling by 13.4%. What do you make of that data?
Well, Stephen, it's important to mention that there was a bit of an accident on the rail front, and that's why some exports of oil, at least not oil, iron ore, was hugely down on the export side. So there were some technicalities, but we know that these data are quite volatile, and we've had some pretty chunky surpluses in past months. So it wasn't altogether surprising that we were going to get some kind of a deterioration in the deficit. The deficit was just aggravated, as I say, by those technical factors. Bottom line, though, from a rand perspective, is that the balance of payments in South Africa looks very favourable at this stage of the game. We've got a current account deficit which is narrowing at a time when we're seeing strong capital inflows into the bond market, into the equity market, and we also have the prospect of foreign direct investment inflow. So from a balance of payments perspective, I think yesterday's trade balance should be largely brushed aside, and that's why the rand didn't really weaken in the wake of the data.
Well, you mentioned the narrowing current account deficit. How about the budget deficit? Because yesterday we had some government finance figures. Did you have a look through those?
I did, Stephen, and they made for very impressive reading. It looks as though we are almost certainly going to undershoot original expectations of a fiscal deficit of 6.2% relative to GDP. We've seen some strong receipts, tax receipts coming in the form specifically of VAT, so that could be a sign that the consumer in South Africa isn't completely dead and buried. Individual taxes are also growing well in excess of what was originally forecast. So, you know, that has implications. It has mixed implications for the rand, because on the one hand, obviously a low budget deficit allows the government the ability to issue less bonds, and lower bond issuance would imply that we could see a further bond market strength, further foreign interest in the South African bond market, which would be rand positive. On the other hand, though, if these revenue overruns continue, it could force at least the National Treasury to increase its participation in reserve accumulation, which we would think would be rand negative in the short term. But I think the overriding factor at the moment are these bond inflows. So I think the former argument outweighs the latter, and that it's positive for the bond market and thus positive for the rand.
Almost out of time. Just quickly, we had Chinese PMI out this morning, slightly better than expected. Of course, this is the official PMI reading, 53.8 versus a forecast of 52. And of course, we're getting our PMI later this morning out as well. And our last reading was just above that 50 mark. What do you think we're going to see today?
Yeah, it's encouraging from an export perspective that the PMI out of China is still doing quite nicely. Our PMI is probably going to improve, but gradually. We've got a lot of headwinds facing the manufacturing sector. Local demand is weak. global demand is fairly weak out of countries like Europe. And at the same time, you've got a strong rand. So I think we'll probably see a marginal improvement, but we're not going to be shooting out the lights for a number of quarters, and thus we're not likely to take too much encouragement from this morning's figures.